There is a rule about gold that every professional on Wall Street learned in their first year on the desk. It was so reliable, so consistent, that for the better part of 40 years, you could set your watch by it. And in the last couple of years, quietly, without a single headline, without one anchor on the financial channels stopping to say a word about it, that rule stopped working. It broke, and almost nobody noticed. If you own gold in your retirement account right now, or you have been thinking about it, I need you to understand what just happened, because it changes the whole story. The people who are supposed to explain this to you, the big banks, the trading desks, the talking heads, either do not understand it themselves, or they understand it perfectly well, and they would rather you did not. Stay with me, and by the end of this, you will understand something about gold that the mainstream has not caught up to yet, and why that gap might be the most important thing happening in your savings. So let me give you the rule, and then let me show you how it broke. For decades, the single most dependable relationship in the gold market was this: when real interest rates went up, gold went down. That was it. That was the law. Real interest rates are just the interest you earn after you subtract inflation, the true reward for holding a bond or a savings account instead of holding metal. And the logic made perfect sense. Gold pays you nothing. It sits in a vault. It earns no interest, no dividend, nothing. So when a government bond started paying you a fat real return, money left gold and went to the bond. When real rates rose, gold fell. When real rates fell, gold rose. Inverse. Every time. You could build a career on it, and thousands of people did. Now here is the part that should stop you cold. In recent years, real interest rates climbed. They went up and they stayed up. Under the textbook, under the rule that had held for 4 decades, gold should have been crushed. It should have bled out slowly, month after month, exactly the way it did in the past whenever rates rose. Instead, gold did the opposite. It climbed. It pushed to new record highs, even while real yields stayed high, even while the reward for holding a bond was supposed to be pulling every dollar away from metal. The inverse relationship, the most trusted rule in the gold market, simply stopped describing reality. Gold broke its biggest rule, and the financial press mostly shrugged and moved on. I want you to sit with how strange that is, because I lived through the version of this that went the other way, and so did a lot of you. Go back to the year gold peaked at the end of that long 1970s run, when it had climbed from around $35, back when the dollar was still tied to gold, all the way to over 800. Along the way, in the middle of that very bull market, gold nearly cut in half. It fell from around 200 to around 100, and a whole generation of holders threw in the towel, convinced it was over. Then it multiplied roughly 8 times into the final top. The rules of that era were brutal, but they were consistent. Rates mattered. The Fed mattered. When the Fed got serious and cranked real rates up hard, gold eventually broke. That is the world every gray-haired investor watching this grew up in. And it kept being true for decades after. For most of the years that followed, the leash held tight. Let the Fed so much as hint that tighter money was coming, that higher real returns were on the way, and gold would flinch and fall. Just the suggestion was enough to send it lower. That is how tight the connection was. Rates up, or even the whisper of rates up, and gold went down, like clockwork, year after year. So when I tell you that recently rates went up for real, and gold went up anyway, I need you to feel the weight of that. It is not a small thing. It is the market tearing up a page it had followed for 2 generations. So the question, the real question, the one the title of this video is really asking, is simple. If the old rule is dead, what is the new one? Because gold did not just stop following rates by accident. Something replaced the force that used to drive it. Something got bigger than interest rates. And once you see what that something is, you cannot unsee it. And you will understand why this is a story about your retirement, and not just a trivia question for economists. Here is the answer, and it is the spine of everything. The force that used to set the price of gold was investors like you and me and the big funds, moving in and out based on interest rates. Buy when rates are low, sell when rates are high. But a new buyer walked into the market, a buyer that does not care about interest rates at all, a buyer that is not trying to earn a yield, a buyer with effectively unlimited resources and a completely different reason to own the metal: the central banks, the national banks of countries all around the world. and they have been buying gold at a pace the world has not seen since the late 1960s. For 3 straight years now, they have bought at a record clip, roughly double the pace of the entire decade before it. When a buyer that size, buying for reasons that have nothing to do with yield, becomes the marginal force in the market, the old rule about yields simply stops applying. That is not a theory. That is arithmetic. Why are they buying? This is where it gets serious, and I want to say it carefully because it is not about politics. It is about mechanics. A few years ago, one major country had a large chunk of its foreign reserves, the money it kept parked in other countries' currencies, frozen, locked, made unusable by the countries holding it. And every finance minister and central banker on earth quietly had the same thought at the same time. If it can happen to them, it can happen to us. And the one asset that cannot be frozen from the outside, the one form of savings that no other country can switch off, is gold sitting in your own vault, inside your own borders. You can hold it in your hand. Nobody can reach across an ocean and turn it off. So the buying accelerated, and it has not stopped, and it is the deepest reason the old rule died. Central banks are not trading gold. They are hoarding it, for safety, permanently. Yield has nothing to do with it. Now I want to talk to you directly for a moment. Because if you are 55 or older and you have $100,000 or more sitting in a 401k or an IRA, this next part is genuinely for you. And it is the most useful thing I can hand you today. You just heard that the largest, most sophisticated buyers on the planet are quietly moving a portion of their national savings into physical gold at a record pace, precisely because they want something no one else can touch. Here is what almost nobody tells ordinary retirees. There is a completely legal, established way for you to do the very same thing inside the retirement account you already have. You can move a portion of that 401k or IRA into real, physical gold and silver, held for you, without cashing out, without triggering taxes, and without an early withdrawal penalty. It is called a self-directed precious metals IRA, and it is not some exotic loophole for insiders. Do you have $100,000 or more in any retirement account? This door is open to you exactly the way it is open to them. I put together a free retirement protection guide that walks through how it works, step by step, in plain English. If you are watching this on your television, just scan the QR code on your screen right now. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing, and there is no obligation. Now let me get right back to it, because the story gets deeper. Because here is what happens when a rule that everyone trusted quietly dies. The people whose whole job is built on the old rule keep applying it, and they keep being wrong, and they keep telling you the wrong thing. Watch the financial channels closely the next time real yields tick up. You will still hear the reflex. Higher rates, bad for gold, get out. That was true for 40 years, so it comes out of their mouths automatically. But it describes a market that no longer exists. And every time a retiree hears that stale advice and sells his metal into a dip because a man on television told him rising rates mean gold is finished, someone on the other side of that trade is delighted to take it off his hands. That is the quiet cost of an old rule that broke without an announcement. The people still preaching it are handing you a map to a country that has changed its borders. Let me stack another piece of evidence on top, because this is not one lonely fact. It is a pattern. Look at what gold has become in the world's reserves. For the first time since the old post-war system that tied currencies to a gold-backed dollar was abandoned in the early 1970s, gold has climbed back to become the second largest reserve asset held by central banks anywhere in the world, behind only the US dollar itself. Behind the dollar, ahead of the euro. That is a European central bank finding, not a gold dealer's brochure. Think about what that means. The custodians of the world's money, the same institutions that spent 30 years telling their own citizens gold was a relic, a barbarous leftover, an asset for cranks, have quietly made it the number 2 thing they hold. They are doing the opposite of what they say, and they are not doing it to earn a yield. They are doing it because in a world where paper savings can be frozen, gold is the one promise that keeps itself. Now, here is the part that actually changes things, the part almost nobody connects, so stay with me. When the buyer setting the price is a central bank hoarding for safety instead of a fund chasing a yield, the whole character of the market changes underneath your feet. A yield chaser sells the moment bonds look attractive. A hoarder does not sell at all. He accumulates through the dips, through the scary headlines, through the shakeouts, because he is not in it for a trade. He is in it for the century. That means the floor under this market is a different kind of floor than the one your advisor grew up with. It doesn't mean gold cannot fall. It absolutely can, and it will, sometimes hard and fast. But the reason people keep getting surprised that the dips get bought is that they are still watching for the old seller to show up. and the old seller has been replaced by a buyer who does not flinch. And this is exactly why the shakeouts fool so many good, careful people. You will see gold get hit, you will see a sharp drop, and the old voices will come roaring back. See, the rule still works. Rates up, gold down. We told you. But then the drop gets absorbed, and the metal grinds back, and it makes a new high anyway. And the people who sold in the panic are left standing on the platform, watching the train pull out. This has already happened more than once in this new era. The pattern is not gold obeying the old rule. The pattern is gold breaking it again and again, while everyone keeps expecting the old rule to reassert itself. It has not. And understanding why is the difference between being the person shaken out and the person still holding. Let me widen the lens, because there is a long cycle underneath all of this that the daily noise hides from you. There is a simple relationship market historians watch: the ratio between the stock market and gold. How many ounces of gold it takes to buy the whole of the blue chip index. At the top of the 1970s gold mania, that ratio fell to nearly 1. Gold and the Great American Stock Index almost trading even. At the height of the stock market euphoria around the turn of the millennium, it swung to an extreme in the other direction. Stocks priceless, gold forgotten. It swings across whole decades, a long, slow pendulum between the years when everyone worships stocks and the years when they remember gold. For most of your investing life, that pendulum has been on the stock side. The central bank buying, the broken rule, the reserve milestone, these are the kinds of things that show up at the turning of that pendulum, not in the middle of it. I owe you some honesty here, because I am not in the business of telling you what you want to hear. Everything I have laid out is a case. It is not a promise, and it is not a guarantee, and it is certainly not personal financial advice for your specific situation. Gold can be brutally volatile. It has fallen by a third inside a bull market before, and it can do it again. The old inverse rule breaking does not mean gold goes straight up forever. It means the thing that used to drag it down lost its grip, and a different, deeper force took over. That is a meaningful change, but it is not a magic wand. Anyone who tells you they know the price and the date is selling you something. I'm trying to hand you the mechanism so you can think clearly instead of reacting to headlines. So what do you actually do with this, if anything? Let me give you principles, not a prescription. First, if you own gold, own the real thing, the physical metal, or hold it in a form that is genuinely backed by metal, not a paper claim that can evaporate in a crisis. Second, size your position so that a sharp drop, and there will be sharp drops, can never force you to sell. The people who get destroyed are not the ones who are wrong about the direction. They are the ones who owned so much or owned it so nervously that a shakeout scared them out at the bottom. And third, do not sell into the panic. The whole point of understanding that the buyer has changed is understanding that the dips in this new era have been getting absorbed. If you get shaken out every time the old voices shout, you will hand your metal to the very people who understand what I just explained. And now, the part one most want you to hear, because it is really what this whole video has been building toward. The smart money already knows this. The central banks already know it. They are the ones who broke the rule. The most sophisticated institutions have already been positioned for years, but the mainstream has not caught on. The pension funds, the financial channels, the ordinary advisor reading last decade's playbook, they are still quoting the old inverse rule as if it were gospel. That is the whole opportunity and the whole warning at once. You are early, not because you are smarter than everyone, but because you were willing to sit through 20 minutes and understand something the crowd has not gotten to yet. And by the time it does get to them, by the time this breaking of the rule leaves the evening business segment and every advisor in America is suddenly recommending gold, the easy part of the move will already be behind us. Nobody sends you an invitation to be early. There's no bell that rings, there's no phone call. Being early feels exactly like this: quiet, uncertain, a little lonely, while the crowd is still looking the other way. That is the honest reason this matters now rather than later. The window when a decision like this is calm and unforced is precisely the window when nothing feels urgent, when the headlines have not caught up, when you still have time to think it through slowly instead of scrambling after everyone else has figured it out. That window is open right now. If you watch this all the way to the end, you are exactly the kind of careful, deliberate person this is meant for. So here's what I would do. I hold a free one-on-one educational web conference for viewers who are 55 or older with $100,000 or more in a retirement account, and who mention that they watched this video all the way through. It is genuinely educational. There is no pressure and no obligation. Just a real conversation about whether moving a portion of your retirement into physical metal makes sense for your situation. If you are watching on your television, scan the QR code on your screen to book it. If you are on your phone or your computer, go to jeffreedguide.com. So let me bring it all the way back to where we started. Gold broke its biggest rule, the one Wall Street set its watch by for 40 years, the rule that said rising real rates must drag gold down. It broke because a new buyer, one that does not care about yield and does not sell into fear, walked in and became the force that sets the price. And almost nobody noticed, because the people paid to notice are still reading from the old book. You noticed. You understand it now. And understanding it before the crowd does is not a guarantee of anything, but it is the one edge an ordinary retiree ever really gets. The rule is dead. The story it hid is only just beginning. And you did not have to wait for someone to announce it to see it for yourself.